Hello everyone, welcome back to another video. My name's Sam and today we'll be shedding some light on a fundamental concept in trading and the biggest appeal that Forex trading offers: margin. We're also going to explore margin calls, margin regulations, and the relationship between margin and leverage. As always, feel free to comment down below with any questions or interesting insights, and make sure to stick around till the end of this video so you don't miss out on anything important. So what exactly is margin? At its core, margin refers to the practice of your broker allowing you to trade financial instruments in larger positions, such as stocks and commodities. So instead of relying solely on your own capital, margin gives you the ability to enter positions larger than your account balance and potentially enhance your investment returns. You can think of it as having control of an extra amount added to your current balance without it belonging to you. It can be advantageous and it might make you feel like you have access to additional buying power, but it's important to know that it can amplify both gains and losses. Because with greater reward comes greater risk. Another thing to remember is that the extra amount that you can control accrues interest daily, adding to the cost of trading on margin. It's vital to be aware of these changes as they impact overall profitability. When trading with a margin account, you begin with the initial margin, which is the percentage of the position's value that you must deposit to open the trade. While the initial margin requirement can vary depending on brokers and regulatory requirements. Let's use the example of a 50% initial margin requirement. Suppose you're interested in trading $10,000 worth of CFDs and decide to open a margin account with a broker. With a 50% initial margin requirement, you'd need to deposit $5,000 into your margin account to open the position. Your broker would then provide the remaining $5,000, allowing you to trade the $10,000 worth of CFDs. This leverage provided by your broker enables you to control a larger position with a smaller initial investment, but that does not mean that the extra money will belong to you in any way. It's only there to allow you to trade larger positions. And this is when maintenance margin joins the game, which is the minimum equity percentage that must be maintained in the margin account. Typically set at 25% of the current market value of the assets. Failing to meet this can trigger a margin call. Let's say, due to market fluctuations, the value of your assets declined to $8,000. To determine your account equity, subtract the amount borrowed from the value of your assets. In this case, it would be $8,000, which is the value of assets minus $5,000. That's the amount borrowed, resulting in an account equity of $3,000. However, if the value of your assets continue to decline, and your account equity falls below the maintenance margin level, your broker will require you to either deposit additional funds or liquidate assets to restore the required equity level. So this process is referred to as a margin call. The primary purpose of a margin call is to safeguard both the trader and the broker by ensuring that the account possesses sufficient equity to adequately cover the outstanding loan. Failing to meet a margin call can lead to the broker selling the investor's securities to cover the loan, sometimes without prior notice. Here's an overview of the margin call process. 1. Security value drops. The process begins when the market value of CFDs held in the margin account decreases, affecting the overall value of the account. 2. Maintenance margin breach. Consequently, if the account's value falls below the maintenance margin, the minimum equity level set by the broker, it triggers a critical threshold breach. 3. Broker's margin call. The broker issues a margin call to the investor, formally requesting additional funds or securities to rectify the account's deficit. 4. Required action. The investor must deposit more funds or sell securities to cover the margin call. When margin trading, it is crucial that you are aware of regulations and requirements put in place to ensure market stability and protect traders from excessive risk. These regulations, which can vary significantly from one country to another, play a pivotal role in shaping the margin trading landscape. Typically overseen by financial authorities such as the Securities and Exchange Commission (SEC), in the United States, the Financial Service Agency (FSA) in Japan, the European Securities and Markets Authority (ESMA), and the European Union and the China Securities Regulatory Commission (CSRC) in China. These regulations encompass a range of criteria, including minimum margin requirements, initial margin, and maintenance margin levels. But remember, brokers may have their own set of rules and requirements that could be stricter than the regulatory minimums. Always check with your broker and stay updated on the latest regulatory standards to ensure compliance and make informed trading decisions. Speaking of informed trading decisions, let's see how margin and leverage come together in trading for a chance of generating significantly more profits. On one hand, we know that margin serves as the deposit or collateral needed to enter a trade, allowing traders to open larger positions than their capital would typically permit. On the other hand, leverage is the ratio that magnifies a trader's exposure to the market beyond the initial margin. For example, a leverage ratio of 10:1 means that every $1 of margin, the trader can control a position worth $10. Consider a leverage ratio of 50:1. Here, a trader with a margin of $1,000 can hold a position worth $50,000. This capacity to control a large position with a relatively small amount of capital can lead to significant profit if the market moves favorably. However, the leverage also increases the risk of losses in equal measure to potential gains. A small market movement against the position can result in substantial losses exceeding the initial margin. Therefore, while margin and leverage are powerful tools in trading, their use requires a balanced approach to risk management. But more details on leverage in another video. Margin trading falls into two categories. You may have heard high margin and low margin before, and it's exactly as it sounds. High margin involves borrowing a large portion of investment capital, amplifying potential returns, but also risks substantial losses due to increased leverage. Conversely, low-margin trading takes a conservative approach, using smaller loans to reduce risk and limit potential returns. Traders choose between these based on risk tolerance, strategy, and market conditions. Forex brokers are often associated with high-margin trading options. They typically cater to more experienced traders and may offer leverage ratios of up to 1 to 1,000 in Forex trading and relatively low margin requirements for other assets. Traditional full-service brokerages or retail banks often adopt a more conservative approach with lower margin options. They typically target conservative investors and beginners, offering lower leverage ratios, such as up to 1 to 50 in Forex trading and higher margin requirements for other assets. It's important to know if the leverage of the broker meets your trading needs before opening an account with them. Margin trading is an impactful device that many traders utilize to enhance their strategies. However, implementing preventative measures is essential for managing risk effectively. Firstly, regularly monitoring account equity ensures it stays above the maintenance margin, preventing margin calls. Secondly, using protective stops, such as implementing stop orders to sell securities at predetermined prices, can help limit potential losses and protect investments. Lastly, managing leverage is crucial, as keeping it at manageable levels reduces the risk of margin calls and helps maintain financial stability. Okay, let's summarize what we've learned today. Margin trading involves utilizing funds provided by a broker to control positions larger than your account balance without them belonging to you. It can amplify both gains and losses, so it's crucial to understand the risks involved. The margin call process is initiated when the account's value falls below the maintenance margin level. Regulations vary by country and broker, but they aim to protect traders and ensure market stability. Preventative measures include monitoring account equity, using protective stops, and managing leverage effectively. That should cover all the basics about margin. Let us know if you want to see a more advanced version in the comments below. Don't forget to like the video and subscribe to our channel. And since you reached this far, here are 2 more videos that you might like. I'll see you next time.